Before you place your next trade, watch this. When markets wobble, smart money shifts. Today, I am joined by Riaan from Heyns Consulting to unpack how institutions and high net worth individuals navigate uncertainty. Curious about what they are really doing? Well, you'll want to hear this. Good day. I'm Francois, your market analyst here at ATFX Africa, helping you cut through the noise and trade with precision. Joined today by Riaan Heyns, an expert in wealth planning. Today, we'll uncover how wealth managers structure portfolios in volatile times and what that means for your trading and long-term goals. Hi, Riaan, and welcome to the show. Riaan, could you please tell our viewers just a bit about yourself and what you guys do at Heyns Consulting?
Hi, Francois. Thanks for the opportunity. It's great to join you on this forum. Um, I've been around in financial services for some time at the risk of my age away. It's been since the mid 80s and primarily in the investments and insurance field. And I was a corporate person for a long time until I established my own practice just over 30 years ago as an independent wealth advisor and doing financial planning and investment planning. All the traditional disciplines like retirement planning, estate planning, and then, of course, asset management and investment planning. So that's my background.
Absolutely fantastic. Riaan, let's dive right into our first question, which is how do wealth managers like yourself prepare for risk during months like the ones that we are experiencing currently where markets are so volatile?
Okay, I think a lot has been the concept of risk is a very misunderstood concept, and it means different things to different people simply because people have different risk profiles when it comes to investments. So risk is often seen as this terrible thing that hangs over our heads. It is a reality which we can actually leverage in our favor. And the strategies that we pursue during volatile times is really no different than during non-volatile times. Thinking about it, I can't quite recall when last we haven't had volatile times. It's been, and I'm not going back to COVID only, but let's go back to March 2020. What has happened since then? We had Russia, Ukraine, and we had numerous other things happening, recession fears, and then, of course, the Trump tariff situation, the Middle East, and more lately the geopolitical issues associated with that. And then on the sidelines, in the shade, lingering things like China vis-a-vis the Taiwan situation and the underlying geopolitical tensions. Volatility has always been there and will continue to be. So to answer your question, the way we deal with it is essentially through diversification. And by diversification, it would be obviously diversification through different asset classes, obviously being equities, bonds, fixed interest instruments, some listed properties as well, and then cash, of course. But you don't only, there's more than just four asset classes that can be utilized and deployed, because both have a local, a South African flavor, and then, of course, you have the global dimension. So effectively, you've got 8 different asset classes to deal with. But on top of that is you are also diversifying different fund managers in terms of style. Investment styles are hugely important and something which is not often utilized. In my particular funds that I use, or portfolios, model portfolios, as we call them, sometimes known as wrap funds, we utilize different uncorrelated investment themes. And I'd like to do that by example. Certain fund managers would be very growth orientated. In other words, they would identify equities or stocks that, regardless of their valuations, are very, very popular, have got high earnings growth potential, and is likely to continue having that despite the fact that times are really volatile. Then there are fund managers that do not like that. They are value fund managers, and you will not find Naspers in the portfolio at the PEs that they are running at. So they would look for often companies that are in distress. You get those deep value fund managers, we call them contrarians, that look for assets that are really in trouble, or stocks that are in trouble, or high dividend yielding stocks, which are often in the value area. So different investment styles are hugely important. So if you have 12, 14 different fund managers with different styles in a portfolio, and you go through a certain sector of the market cycle, it may very well be that three or four of them underperform. If the Nasdaq runs like hell and your deep value stocks are going to underperform, be sure that you're going to have enough growth orientated fund managers that would be holding those stocks. The key is everybody can make money during a bull market. What happens when there is a downside? And that is where wealth managers must add value. Yes, if there's a bull run, capitalize on that, make the right tactical moves, make sure that you select the best fund managers to make those calls. But when things go south, as we call it, that there is enough defensiveness being built into it, whether that be through diversification or the utilization of alternative strategies like hedge funds and alternative investments to be able to defend the downside.
Super tight spreads. Yeah, tighter than your jeans after Christmas lunch. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
Well, excellent. And thank you so much for that extremely detailed explanation. Let's shift gears a little bit. Are you seeing because I know you spoke a lot about now different diversification and so forth. So with markets as you see them currently, are you seeing a rotation between equities, bonds, and cash? What's hot right now? What do people like to invest in right now at this specific stage?
Okay. I think equities will always be the primary asset class. It's just the way it is. It is what we know. And they come in different guises. Like I've said, there are those deep value stocks and so on. So there's enough to work with within the confines of equity. Just because there's huge volatility doesn't mean that we now have to run away from equities. Not at all. However, it is what we do with the equity composition. Again, and I don't want to repeat what I said in my long intro response, but different themes, and you will be pursuing areas such as going traditional. Let's leave the let's leave the Magnificent Seven for a while. Let them cool down. If you want to have some in your portfolio, that's fine. But go back to your roots. And what are the roots? And those are the well valued or undervalued high dividend yielding stocks that used to work so well. Focus on yields. In South Africa, we are also very fortunate that because of our yields on the high yields on the fixed interest side, we can use our bonds. And we've, over the last 12 months, I mean, the bond performance in many ways have carried the South African market. And it's along, of course, with gold during the geopolitical situation. That's always helpful. But no, we will not be moving away from equities. It is how it is deployed. It will be, but other alternative strategies will come into play. And that would be hedge funds. Commodities will certainly be playing a role. Not huge. They will not become dominant asset classes, but they will be part of the diversification process. And I envisage that will continue to happen. But these things, people have short memories. The moment there's some positive news in the market, guess what? Everybody's back into equities again. But without being too facetious about it, there will definitely be a look at alternatives, and hedge funds and alternative strategies is certainly a part of that, along with other things such as, for example, global fixed interest is becoming interesting and attractive because of yields over there. So we continue the theme of diversification, but we retain our equities.
Riaan, this has been absolutely super insightful so far. But, as the majority of our viewers here today are most probably retail traders, and, myself and you have had the discussion on that. All retail traders are always interested in is charts, and more charts, right? So if we had to go beyond just charting, as a wealth manager, what do you wish that traders specifically would also consider? Is it things like taxes, estate planning, capital growth strategies? What do you wish they would expand a bit more into?
I think it's actually I think it's a hell of a good question, simply because the two disciplines, the one of trading and the one of financial planning and advice, are seen as two distinct avenues of interest. I have a lot of respect for traders because they have the guts and, to actually go and make those high conviction calls. I have the luxury that I can identify really, really good fund managers to make those calls on my behalf. The ultimately, I can blame it on somebody else. The trader can't. You see, he is right there. But to answer your question, I believe that there could be a closer collaboration in terms of the business interest and the disciplines that we pursue. I am very interested in what the traders do. When they make a mistake, I don't even know about it. I will know ultimately if one of my fund managers that's in my portfolio, for example, we struggled with China a bit, and China with a regulatory environment and so on. I was exposed to China, more exposed than my peers, and I thought, well, it's the second largest economy in the world. Those companies are so well run. They are bringing out these amazing products, and they're so cheap. They're going to have to come to the party, and they lag behind, and we stuck to them, and we spoke to the stock pickers, who effectively would be the equivalent of the traders in those portfolios. And we held out, and they said, okay, now we're going to keep it like this. And we did 34% in 1 month on China alone. Okay, so the stock pickers and the traders, and similarly, are the guys that have got to make those high conviction calls. To get back to what I think was more closer to your original question, and that is, can we work closer? I would like to believe that traders can, and that perhaps the financial planning side of things, people like myself and traders should be working closely together. I think it would be great and also very satisfying for both traders and financial planners to be able to part of the bigger picture in terms of the investor's longer term financial plan. There has to be an understanding of that person's retirement planning. What is the person's risk profile? Rather than just clinically look at specific stocks or commodities that need to be traded or whatever. It's got to be part of the bigger picture of a specific client or group of clients that meet a certain risk profile. I think it also will it's a very exciting thing to be able to actually expand your world a little bit. In my case, my word of holistic strategic planning, and to get my hands a little bit more dirty in terms of what's happening on the floor. And similarly, for those traders that are interested in getting away from just being on the floor and banging the fist, to say, hey, what am I doing? How am I fitting into the bigger picture? What can I do in conjunction with, say, a financial advisor, and say, it's a collaborative plan that will be in the interest of the investor. I know this is a philosophical reaction to your question, but I think there's opportunities for overlap.
Zero commission on stocks? Yeah, nothing. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
You actually mentioned risk profiling twice in your answer. So I want to build on that a little bit more. So, we were talking about volatile markets just now, and you were saying that, you can't remember a time where markets weren't volatile almost. But, if we had to build on that, how does your approach to risk profiling evolve for clients at various stages? Okay. Obviously, we have clients who are early in their career or mid 30s, mid 40s. And then you have clients who are in the latter part of their career, late 50s to 60s. How does your risk profiling differ between these various stages? And what is your approach normally with these types of clients?
Okay. Traditionally, what happens with risk profiling is, obviously, by risk profiling, we mean the client's appetite for risk. Now, that has got, generically, it's got two dimensions, in my view anyway. The one is, where is that person in his or her particular stage in life? In other words, is it a younger, a college or university graduate, or somebody that's just left school, just started a small business, starting to plan buying his first house or her? When I talk about him or her, I deal with both, okay? So just to be politically correct. When it comes to planning for younger people, the biggest variable that determines your risk profile would be time. If you're going to have a hell of a lot of volatility, and I mean, I just looked at volatility charts since 1984, because that's really when I was born in the industry. And I look at everything that we've gone through with all the global meltdowns and stuff. I've seen quite a few of them come and go. And you look at the returns over time, average annual compound return. I say this a little bit tongue in cheek, but it was really just noise. And because you had time on your hand. However, if you're in 2006 and you're about to retire and you anticipate the 2008 global meltdown that's going to happen, you would actually like to put that person's pension fund into something a little bit more secure, like a smooth bonus type situation or more fixed interest environment or an absolute return strategy. So the risk profiling is determined by the term of the investment. But to me, the most important thing is a psychological one. What is that person's propensity to handle risk? Is it the type of person that will stay awake at night rather, because of volatility? My approach to risk is a little bit different to most. I look at a client and say, how does it make you feel if you see these markets around you? And there are many people that you would deem to be quite conservative that would say, I don't really care, Riaan. If you guys think it's okay to be there, then that's fine with me. You know, people really, really trust you with that. And it's a huge responsibility to carry. Other people literally log into their portals on a daily basis. And boy, if NVIDIA has dropped by 5% overnight, they pick up the phone and they call. But if that puppy runs by 15%, in a day, everybody's happy. So risk profiles are more often than not, is a psychological thing, and that needs to be managed. Therefore, the financial planner must be a coach rather than a numbers manager. I'm not a stock picker. For that, you pick the right people to do that. My job is to educate people as to what is appropriate risk. I don't really believe in the life stages thing. Many people do. We say you're a young person, so we're going to start you aggressive. Now you're approaching your 45, 50. We're going to go for a moderate risk profile, less equities. Now you're getting close to your retirement. Now we've got to be super careful. No, you don't do that. You start with the person's appetite for risk and you interpret what the markets are doing. If you've got 10 years to go until retirement, you can afford to be aggressive. Okay. Then people retire. What happens then? The notion is then that you got to start boxing conservatively and you have to reduce your risk profile or your risk strategy in your investment. If you're going to have an income percentage drawdown of your capital of 5 or 7% per annum, you can't afford to have a cautious approach on your living annuity because you will not get any capital growth. You will be depleting your capital within 15, 20 years' time. But because you've got time on your hands, if you are retiring at age 60 or 65, the actuarial life expectancy of the average South African is in the mid-80s now. I've got pensioners well into their 90s that retired 65. That capital must be sustained. And the only way that you can do that is to be aggressive. So it probably sounds like I'm by nature an aggressive person when it comes to investments, and yes, I am. But I do not impose that on my clients. But the point I do want to make is that, yes, box conservatively if you believe the markets demand that, respect that, and operate accordingly. But if you have time on your hands, be prepared to sit through those volatile times because history has taught us that it will always bounce back. It might take a bit longer, but it will bounce back.
Absolutely fantastic. Riaan, last one. So, what would your advice be to someone in their 30s? What can be the smartest move someone in their 30s can make to kind of secure long-term financial freedom? Because I know a lot of traders, and especially retail traders, mindset's always very short-term. But we have to start thinking long-term. We have to, you were talking now about, people age 95 living off their retirement funds, So how can someone that's currently in their 30s prepare themselves for that longer term financial freedom?
Okay, very good question again. I think your starting point must be, as being in your early 30s, is not to be too hard on yourself that you didn't start when you were 25, which was when you were supposed to. But
or 21.
Let's cut yourself a little bit of slack and say you had a little bit of fun to catch up on and so on. Okay. But in all seriousness, it's a huge question because we are not a particularly good nation when it comes to saving. I think it starts off with two things: goal setting and discipline. With goal setting, it would be a good idea to actually say, right, what are the things that I would like to do? Right, that when you're in the early 30s, so some people might be in a long-term relationship, anticipating marriage. They may very well be married already, looking at having little ones, acquiring a house, etc., etc. So for those things, you've got to set financial goals. And then obviously look at what you're earning, and if it's at all possible, live slightly below your means and make sure that you set aside, inclusive, whether you belong to a company pension or provident fund or not, but you want to set aside about 20% of your income in a monthly recurring contribution. And the purpose of that is really just to inculcate that discipline of saving for the longer term. It can have the many different vehicles in which you can choose from, whereas retirement annuities in the old days were regarded as not particularly good investments. And in those days, perhaps rightly so, because the costs were exuberant, made many financial advisors very rich. These days, it's very, very cost effective, and the tax breaks are insanely good. So that would be an option. Another one that's a no-brainer is the so-called tax-free savings account that came into play a couple of years ago. Everybody should have that. I mean, it is just a no-brainer not to have. And you can have, offshore portfolios, very exciting portfolios, linking them directly to the NASDAQ, to the tech companies. We've got access to, Signia has just launched a crypto EFT on the back of BrightRock, I think it is, where they, you can now go and have a tax-free savings account that incorporates crypto. So there are exciting things that young people can do. But the important principle is one of respect the potential or the positive aspect of compounding interest over time. And understand that you may very well live for a long, long time. The actuarial life expectancy of a 25-year-old non-smoker when I started off in insurance way back was 72. It is now well into the 80s, and people live longer than that, and we all want to retire at a younger age. So young people, put some money away. There are many, many options available to you, as I mentioned.
Absolutely fantastic. Riaan, this has been incredibly insightful, and I look forward to having more discussions like this with you. And then traders, that wraps up your daily market brief brought to you by ATFX Africa, the broker that gives you an edge in today's markets. If you want to experience the difference for yourself, simply head over to ATFX Africa. Traders, until next time, stay sharp, stay focused, and trade smart.